All right, Feb 24. Let's jump into the trade update for today. So we've got the Australian market to do, and then also we can check in on the overnight movements for the S&P 500 and the trades I've got on there. I'll just switch over. So last night there was a pretty massive drop on the S&P. Here, 1.84%, and then the Australian market's sort of moving with it now. The VIX is going up after sort of resisting that move yesterday. It's dropped at the open, so in 26 minutes, 1.83%, which is a pretty big drop, and the VIX is up only 7%, which is not as much as I would have thought with that kind of movement. And yeah, everybody's getting the jitters, which makes sense. So if we jump into the trading platform, that movement's been pretty good for most of my accounts. So this is up. The margin position's up $4,000, $5,000, and the liquidation value's up $100. And we'll see what that those insurance contracts were doing across all of them. This one, let's check this one. This is down. That has an index holding as part of it, so that makes sense. So it's not just options contracts; it's also equities. But similarly, the margin position has improved. And then if we look at my simulated sort of more extreme Condor account, it's benefited as well, which makes sense because it was pushing the top end. So margin position is improved by 5,500, and the liquidation value has also gone up by 2,500. Now that might warrant us closing some of those positions. I'll start with this. Let's just check out where it's at. It's a massive drop, and I wonder if it'll continue to go past, if it breaks past 7. ADX is above. It was above 20, but it's been above 20 for a while. Above 20 on that average directional index apparently indicates strong trend. If that continues to go up, then we'll see. But it's sort of flattened out and sort of lost momentum after this big drop. Some people like it. They think it's like directionally right, but it's often lagging. You see here, like once it broke past 20, the majority of that movement had already occurred in that last crash. So it sort of went down. ADX was still all the way up here. So it's, even though the market was improving, so if you trade on that trend, like, it wouldn't make any sense. Implied volatility is still, it's around neutral, so it's around where it's been for a while now. Let's check out the portfolio. So I'll just filter to the Condor first. I'll zoom in a bit. So it's a solid gain on this Condor. It's now in profit. Yesterday it was basically break. It wasn't making any money. Now it's made $1,500. 21 days to go. Basically, these calls have fallen in value, and that hasn't been met by the put side yet. Although, if the market keeps falling today, that may be eroded, and it's appreciating in value. The net theta of all of these positions equates to $158 a day. So these positions are accruing $158 in retained value into my account. That's how you read that net theta. Margin effect's totally out of whack. I don't usually look at that. And the delta, which is what I always look at, is looking pretty good. So the puts are at 10, which is where I opened them for. So that's fine. They've been sitting pretty high. the calls have lost. Delta is a shorthand for in the money probability. 4%. Really, you have to worry about these ones. So that's 0.9 or 9%, 0.4 or 4%. So that's good. You want those to be falling. Under 10% is good. We generally open them at 10 in this strategy. Anything above 20 is what you worry about. Anything above 30 you need to move and adjust, is the trading rules. If we get rid of that and look at the insurance contract here, it's now come back into basically what I bought it for, almost. So I opened it for $179 per contract times by 10. And it's now sitting at theoretical prices at 175. So let's just stress test this and see what will happen. If it falls another 2% tomorrow, what's going to happen? You could see the theoretical price would go up to, in theory, $200. Volatility will probably go up another 10% if that occurs. I think if there's another big fall tomorrow, what I might do is I'll close these puts and this insurance contract, and I should be able to make money on that. I'd make about $898, which is good. Okay. Hopefully that doesn't happen. We can let it just go to expiry. All right, live accounts. Let's see what's happening. So a few days ago in the trade log, I opened some insurance contracts because short-term issues like invasions, wars, things like that, particularly between someone like Russia, which is responsible for a lot of energy, have a lot of impacts on the market potentially. Although yesterday it didn't seem to worry the market, today it's worried the market. This side of this condor here is not looking too healthy. I opened it for pretty poor amount. It's because this live strategy is a more conservative one, so I open those contracts further out of the money, so they have are less able to respond to sort of situations like this. But the benefit is they go further outside of where the market sits. The market's sitting at 7,076 points. Underlying sitting another almost 100 points beneath that. So the market's expecting this to continue to fall. This position is set at 6,300. So we've got 700 points to fall before that goes into the money. So the delta is sitting at 9, so that's fine. It's not in a bad position. The insurance contract here has now gone into profit. So I opened it 2 days ago for $14. It's now gone to $16. But because it's so small, it's only 2 contracts, it's profit. It's only gone up to $48. So it's not worth doing anything with that. Basically, those are just there in case the market falls a lot and it will reduce my loss. It's not going to turn it into a profit for me because it's sitting at the same expiry. The next change to this strategy will be to create a long-dated insurance contract so that when these movements occur, it appreciates that significantly more in value, so you can close them and take a little bit of profit off the table in addition to having the protection. So for example, tomorrow, if it falls more, the margin would improve, but we'd be looking at sort of $350 loss, but not realized loss. With volatility going up, it'll probably do the same. If it goes down to 5%, what will happen? $1,000 probably. With volatility going up, it would do that. If we go down 10%, if it goes down 10%, volatility would go up a lot. We'd be looking at a $531 loss, which is not bad. And then I would definitely be closing those. You want to close these before they get to your strike price, because as soon as it gets past the strike price, your loss is significantly higher. You go down, you're looking at, actually that's not too bad, but if it went down 15%, volatility would keep going up. That's not too bad. It goes into profit, but we don't know that that's exactly what would happen. Yeah. Ideally, you don't leave it until that point. So that's the live account. I'm not going to do anything to that today. Just checking it. This is my next account. Okay. Now, an interesting thing that I will show you. So this is basically in the same place, although the insurance contract is a weekly, only 14 days of coverage. It was slightly cheaper, but if that gets to the point and this volatility in the market has not worked itself out and this Ukraine thing is still pushing on, I might have to roll that out and incur that cost again, but we'll see. That's as yet unknown. What I did do yesterday was lodge collateral. So this is part of my underlying strategy where in this account, and it's what I'll do in my other accounts as they grow, is that I lodge index fund underneath my options positions, and I'll use that as collateral to trade, and it's available to me. What that means is basically the market maker, or sorry, in this case, implied volatility, they use your shares that you own, and they say, we'll take a portion of the value of these shares that you own and lodge it against as collateral against your open options positions. It's quite helpful because the equity value in this account is 76 grand. Before that was lodged yesterday, the only thing I could trade on and use was my $73,000 worth of cash in the account. Now, that's not great, because then if you have a spike in margin requirements, so you have two condors open, you've got a lot of margin, and you don't have any insurance contracts open, so your margin requirement spikes, you can actually get tested and have a margin call potentially, which is the opposite of what you want to have happen. You never want that to happen. You can lodge a set of shares. It has to be within an approved list that's provided by the ASX in Australia to lodge against those positions. In this case, I own an ETF, a Vanguard ETF of the Australian share market, and I've lodged that as collateral. Come up here and say, look, I've got 826 shares of VAS as the ticker, and then and the price that it's lodged at, and it says the haircut amount, which basically the haircut means the market value that they will discount that by. Basically, they do that to say, look, if the share price fluctuates, we want to discount that so that the amount that you can use as margin isn't underneath what the share price might fluctuate by. So 15% is the haircut on an ETF like this. With shares, it's often larger. With shares, it might be 30%. CBA, some of those big ones are higher. So the total value that I can use and lodge against my margin requirements for this is 63,000. The benefit of this is that this can, I have that just lodged in as a dividend reinvestment, and it goes into your total account return, but you can leverage that to create extra income via options contracts and iron condor strategies, which is what I trade in over time. So you can enhance your returns across your total portfolio and use that money, which is great. Cool. So this account, its P&L's negative $322. If I liquidated all this today, it'd be down $300. But by the end, so next expiry, it should finish at 148,828. Cool. So I'm not doing any trading today, but that's sort of an explainer of some of those elements on here. Now I'll jump into the trader workstation. For the overnight. This strategy in the US. I'm using Interactive Brokers. These guys, they don't have the best trading. Well, let me rephrase. They don't have the most intuitive trading interface. It's obviously very powerful, but it's not as good as what I'm used to in Australia. But I am testing out iron condor strategies and paper trading through this, and I'll probably start trading live in about 2 to 3 months. But what I'm more interested in is just let's close some of this. It's here. I'll move this up. So this paper trading account, you can sign up for it, follow along. They start with $1 million virtual amount. I'm just trading the same iron condor strategy, but in America. One of the reasons why I really like it is because the fees are much lower and you can start with a lower amount of capital. So I'll explain some of this. The total margin I need for my account in this is $8,728. Basically, to trade this strategy that I use in Australia, you need basically about $40,000 to $50,000 in cash or equities that you can lodge, cash or shares. A large chunk of that needs to be cash. In America, you don't need that as much. The requirements are as low. You can write less contracts. There's more depth in the market. You can get better fill rates, and you can actually make the strategy work there. Plus, the fees are lower because the volume is so high. So at the moment, I have total margin required is 8,728 Aussie dollars. For a return of have a current condor open, that should earn, as you can see, net liquidation value. I could actually close it right now and make $887, which is probably not a bad idea. But the unrealized total potential return is 1,109. I don't like that the portfolio isn't at risk. I think I could probably just leave that. And if I can expand this, there we go. Slowly but surely. Here we go. This is what I have open now. I was closing, ignore these ones that say 0. I opened and closed a condor that was set incorrectly because I'm still learning this. That's why it's important to paper trade for quite a while before you do anything. So in here I have one insurance contract that I've opened for September, and one condor here. So an April condor that you can see the prices haven't moved that much. Real-time market value, so these ones, which are the puts, have risen above the point at which I opened them, but my insurance has risen as well. At this point, I probably wouldn't do anything to this. I definitely won't. What I might do is do a few kind of experimental videos around different strategies in here, also exploring the interface, and then post them. Cool. All right. So I'm not going to trade any of this today, but if it goes down again another 2% tomorrow, I might trade these out. Oh yeah, that's a better view. You can see it there. So there is that put, and there is the put, both sides of the bottom side of the condor, and there is the put, the call, and the call there for the top side.